Hi, good morning to one and all. Don't worry, I'm not going to be starting earlier. I'm just making sure that my microphone is all working and my video is live as well. So looks like it is, but whilst you're early, if you do have any questions, then feel free to type those into the live box. And I'm just going to kick us off with any comments that you guys might have. So I'm just going to say good morning. And if you could just reply back to me, I know that your keyboard is working and you are with me rather than just viewing it. So hello, good morning. I will be starting in just a couple of moments. It is currently 8:54. So I'm just doing my sound test. Everything seems to be fine. In fact, if you can reply, say good morning, and I can hear, that will help me a great deal. So I shall see you in another 2-3 minutes, and then we'll get started. See you in a second. All right, good morning to one and all. Hope you're doing well, and thank you for joining me on this Saturday morning. It is relatively bright and sunshining, so I am pleased that the ones that have certainly come to join me today are on board. So thank you ever so much for that. I wanted to first of all just go through what the agenda is for today. So I'm just going to go through that now. If you can. But before I do, I was going to go through a summary of the coronavirus and the various updates I've been doing during the weekdays this week. I'm not going to do that because we've got a lot of content to get through today, so I don't want to utilize that time. But do please feel free to check out the videos I have previously done on this, just so that you can get an idea of what is going on with coronavirus and the financial impact that it most certainly will have on you and I. And then you can then keep up to date, maybe take advantage of some of the things that I'm highlighting, but more importantly, just to be kept informed. So do watch those videos and join me weekdays at 8 p.m. I'm going to be doing it Monday to Friday next week. On YouTube Live again to go through all the details that I can. Moving on, let's talk about the positives though. Let's talk about the property tax. So obviously you make lots of money in property, I'm hoping. That's why you have a tax liability. But the key job for me is to make sure that you as a UK landlord property investor, call yourself as you may, but I'm here to reduce your property tax liability at all costs. And to do that, I need to give you the best tax advice, and that's why I'm doing these YouTube Lives. Okay, so what we're going to do, the agenda for today is to go through the tax changes and the property strategies that you may be undertaking right now. I need to make it relevant to what you're doing. And I also need to make sure that you're aware of the taxation legislation, there you go, taxation, hashtag that, here it is. Simon Misiewicz has come up with a new word for today. It's taxation. There are so many connotations in that word, isn't there? But tax legislation is what I'm going to be going through. And we're going to be looking at stamp duty land tax, or SDLT to you and me. We're going to be looking at Section 24 mortgage interest relief cap, which is in its final year in this 2021. And we're also going to look at things like partnerships and limited companies. And there is a bonus section in case I finish, which is all about capital gains tax as well. It does depend very much on, do I have enough time to be able to do that? If I do, then that would be great for me to go through the content with you. By the way, I'm going to sprinkle this throughout the session. This is a free property tax workshop. I hope that I am stimulatingly brilliant, as I always am. But if it's useful, don't forget to press the like button, smash the subscribe button, but more importantly, give me a comment. Tell me if that's useful when I'm going through some tax stuff, how you're going to use that particular strategy. Drop that in the comments box. But if you have any questions, clarification questions, or things that you think, well, actually, could we do this as well? Then please, please, please do drop that in the comments box. I have my wonderful, dearest, lovely wife with me today, and she is going to be able to go through some of the questions for me as well, and then type some of the replies. I'm going to do it verbally, but you don't want to be hear me ticking away on the keyboard. So Louise is going to help me with that. So hopefully we can get you on board with the tax savings, but I want this to be engaging. So please, please, please do type away your comments and suggestions. Obviously, there are many types of taxes that we need to consider. So first of all, when we're buying a property, we've got this horrible stamp duty land tax. Stamp duty land tax, funny enough, is not in every country, just pretty much a handful of countries that use stamp duty land tax when you're buying properties. VAT, so when you're buying materials for your property, or indeed you're using labor, then some of those will be VAT 20%. When you've made profit, you have income tax, or indeed, if you're in a company nowadays, then you'll have corporation tax as well. When you sell a property, you pay CGT, capital gains tax. And well, finally, when HMRC, well, when the world is done with you, HMRC haven't. They still want your money even when you are dead, which is really bad news. So we need to protect ourselves from all of those amounts of tax. I racked it up at one point in stage and found that we are paying over 70% of our income in tax in different formats, but it is in tax. So let's just go on from that. There's been so many changes, but as the writing says, I'm always looking for solutions, not crying over problems. There are people that are glass half empty. There are people glass half full. I'm brimming. I'm all the way over the top there. I'm full in that glass. I don't care about any negativity. I turn a negative into a positive at all times. There's enough negative people out there, aren't there? So my view is to be positive at all times, at least try to be, even though I've worked incredibly hard this week, and I probably look really haggard. That's why my image, as I'm coming through to you, looks pretty small. If I could make it even smaller, I probably would. But moving on to property tax. So if you recall, we've got, and these are changes from 2016 to 2020. So I'm really going back now for all the changes. So there's the removal of the 10% wear and tear allowance for those that had furnished holiday lettings. There's the stamp duty land tax, which we used to have to pay after 30 days. Now it's 14 days. There's the 2% and 3% SDLT surcharge, which we have to be aware of. Section 24 came blundering in to prevent you from offsetting the mortgage interest against your property income. Capital gains tax reduction and CGT payments within 30 days. So some of those are going to be hammering us as well. And entrepreneurs relief with TAR and the 2-year ruling. We won't go into that too much detail. I have done a video, so do make sure you look at that. And GAR, use of limited companies. So GAR stands for General Anti-Abuse Rules, that prevents someone using a limited company to get a tax advantage. Now, interestingly enough, controversial or not, there are a lot of companies out there that are suggesting using an LLP structure and then having a limited company as a partner. And by the way, these guys might be spending thousands of pounds on marketing and then charging you £15,000 for the privilege. I'm not going to name and shame. I'm not that kind of person, but I was thinking about doing that, but it's really, it makes me look like the bad guy here. So I'm not going to do it, but there are companies out there that say use an LLP structure, use a limited company as a partner to siphon off the profits. The issue you've got there, GAR was blatantly pointing that out as an abuse rule and therefore tax evasion. So please don't fall into that trap. It is one thing to be rich and wealthy. It's another thing to be greedy and broke. When HMRC do catch up on you, ask the comedians about tax. And is it a funny matter? Probably not. So those are all the changes, and we have to keep abreast of them. And that's why I created this channel. Optimise Accountants pretty much serve a lot of clients, but not across the UK as a whole. So I wanted to get some messages out there to help people, even if they're not clients. So let's talk about property strategies. But before we do that, I want to ask you the question. This is whereby you, as the audience, now get to engage with me, your lovely host. Well, host. But please type in your answer to this question. Are you looking to grow your property portfolio? So I'm going to give you a couple of minutes on that. But what I'm going to do is I'm going to try and answer that as well. So are you looking to grow your property portfolio? I'm going to type in yes for me, but it may not well be what you expect. But I do want to hear from you if you are investing in property. So I will let you type that in. And what I will do is then come back to that point later on. There is a lot of yeses coming through, so that's good to see. So even though the tax changes are coming on foot, it certainly doesn't look like it's stopping you from wanting to invest by the looks of things. So I'm delighted by that. I think, so you may have said not residential. And that's an interesting one, because a lot of these tax changes that you are seeing are about residential, attacking residential lets. Happy Rooms saying thinking not. Okay, Happy Rooms, if you don't mind just saying why not? Is it just because of the tax, or is it because of legislation changes that's really affecting you on that? So, well, okay, so most people are saying absolutely it's a golden time. Man one, Chabal, you're right, it is a golden opportunity. I think there are lots of money to be made in property investing. And the way I believe you can do that is simply by looking at residential property investments. And when we get to a recession, overcoming that recession, then property prices might dip. People may have overcapitalized on a property and may want to come out of that property, and you could be doing them a favor. So as long as you do it in an ethical way, everyone I'm talking to there, then I think you can make lots of money. Someone's saying about not performing well, about selling properties, and that's an interesting one, Lisa. So I will be coming on to that about selling properties that are not performing very well at all. So we'll go on to that. And thanks very much for participating with me today. It does make it more engaging for you, keeps you awake, for instance, for starts. But it also makes sure that I'm on track and that I know exactly how to feed this into you. So there are different types of property investments. There are single lets, houses of multiple occupancy, service accommodation, and holiday lets. Now, I've done kind of service accommodation away from holiday lets, and there is a reason for that. Single let property, let's just describe that. So that's your 2-bed, 3-bedroom house, and you've got a family in there, and then they pay your rent. I have to say that single lets are a fantastic way of investing property if you're starting out in property. There are a lot less noise. And if you haven't got into property, I wouldn't move straight away into houses of multiple occupancy. I was investing for quite some years, then moved into HMOs. And I have to say, I wish I didn't. There was just a total pain in the butt. There's a lot more time involved because you've got 5, 6 tenants that you constantly have to deal with rather than one particular tenant. You've got the upset in the household you've got to sort out. You've got the communal areas that no one wants to clean. So you have to end up doing that, or it looks like a pigsty when you're showing new tenants in. So it's just a bit of a faff. Service accommodation is, again, time intensive compared to single let and even HMOs to that degree. Single service accommodation, for me personally, I phrased it this way because it's a holiday home, but you're not providing services to them. So you might have a key lock box, they let themselves in and they let themselves out. Well, we hope. They don't just stay there forever. And then eventually they vacate that property, you clean it and get it ready, put the key back in the lockbox, and away you go for the second move. Holiday lets for me, though, is more to do with bed and breakfast, guest houses and stuff like that. That's where you are generally providing services. Now, if you're providing services, that could be whereby you are doing cooked breakfast in the morning, you're doing bed sheets, you've got a concierge even service at the front desk, and you're doing evening meals. So those are more service-based activities. And I have to say that service accommodation can give you a nice income. But I do also think that holiday lets is one of those things that people aren't doing enough of. People do like to be looked after when they go to one of these properties. You tend to find true guest houses, bed and breakfast, holiday lets in places like Dorset in the south, Blackpool in the north, which, by the way, isn't so bad. and Skegness even. So there are different types. So it is a property. If you're starting out, maybe single let properties is a good route. HMOs, you can make more money, but more time intensive. And I have to say, rate per hour, I'd have to question whether you can get more money using a single let than a HMO because the amount of time you have to invest. I'm not convinced. I'd like to hear your experiences on that in terms of, am I talking out my butt here? Whereby you can make a lot more money on HMOs and you systemize it brilliantly. Maybe you could share some of your advice on that. And then there's commercial properties. You know, people don't talk about commercial properties enough. In fact, at all. So I know that Ranjan, who's got a great YouTube channel, go to his. I know he does a lot of commercial properties. Great guy, nice to talk to be fair, bless him. He's got a great channel. His subscribers are a lot more than mine. So I'm hoping that you can change that today by smashing that subscribe button. Moving on. So you can have shops, offices, and restaurants. And in those, you can have a position whereby you have genuinely got a property investment, but you have no maintenance. You don't have to deal with a tenant on an ongoing basis. Most commercial properties have a self-maintaining lease, which means that they have to do all the maintaining, not you. There's also other lease agreements, which is upward only rental income for you. So do think about those. All the tax changes that we have seen and we'll be talking about today are targeting residential properties. They are not targeting commercial. Now, you have to say you do need to be very, very careful in regards to the commercial properties, because if you look right now, you've got shops that will be empty because of coronavirus. You've got offices that will be empty because of sociology is pretty much moving people to work from home and hot desk in the office, which means less space is required. So there's a diminishing demand there. Restaurants, well, cafes, restaurants, bars closed last night, didn't they? I bet there's a few sore heads, and that's why they are not here with me talking about tax today. Ooh, that would be hard work. But all of these things, you had to think about supply and demand. So do choose carefully. It's not a session I have to say about this. And there are other things that you could do, commercial to residential. So I will go into a bit of detail about stamp duty, but if you buy a commercial property, the stamp duty land tax is cheaper than a residential. So people are buying commercial office. Give you an example, but you might find in a residential estate, you have a dentist. And in that dentist, you will find that it looks exactly like every other house, just bigger and on a corner plot. Well, if you buy that dentist, it's commercial, SDLT is much cheaper, and you can convert it to residential. Not only do you reduce SDLT, but you can also reduce the VAT on conversion as well. So there are a lot of things that you can do in property. What I would always say to people is find out what you are passionate about. I personally wasn't passionate about the HMO at all. Haven't really tried my hand in holiday lets, but it could be something that we try in the future. Not quite sure. But single let properties do like those because they are easy to manage, and away we go. So what property, so back to you. So wake up time, hello. So what property strategy are you focusing in 2020? Are you looking at resi single lets, resi HMO, holiday lets, commercial property, or property developments, whether that's converting commercial to resi? So those are the key words I'd like you to use. So please now over to you, type in your answers, and I'm going to go with holiday lets. It'd be interesting to find out what people are saying on that. While you're doing that, I'm going to say I need to spend some time just looking at the questions that have been set. So I'm going to do that right away now. So let's have a look. So please explain section 24 threshold versus income, under 50k income. Paul, I will be going through the section 24 later on, so don't fear, I'm going to be going on to that. Lucky to, I've done those. All right. Oh, happy rooms, thank you for replying. Strategic thinking, maybe into looking into incorporation, perhaps after that max 10 mortgages in sole name with my name as the lenders. I will talk about incorporation later on, Happy Rooms. So don't worry, keep with me on that. Kuram has said how things will look with private landlords with 3 or less properties with GAR in place. I'm going to talk about GAR and Incorporation later on, so do stay tuned, Kuram, about that. Lots more questions coming in, which is brilliant to see. Mr. Tubaview, nice name, Mr. Tubaview. So I have a natural, just reading it properly here, flow of tenants in my 4 rooms, sometimes all great, sometimes a problem tenant. I have expectations of being that the case. Yes, I agree. I think HMOs can be great, but it can be very troublesome as well. Same as above, how things will work with private landlord, 3 or less properties with GAR in place. That's an interesting one, saying like 3 properties or less. I don't really think it matters whether it's 3 properties or less with it. GAR is all about, have you got a legitimate business in place? And there are things of incorporation, which we'll talk about later on. But let's go back to what you've been saying. So HMO, holiday lets, single lets, HMO, residential, 2 times HMO, Mr. Tubafu. Lucas is saying, I already converted most of my buy-to-lets to holiday lets. Good. HMO and holiday lets from Teo. Good to see you, Teo. Resi single lets BRR. So Patrick said single let BRR. For anyone reading that and not sure what it means, it's buy, refurb, refinance. Okay, so just so you know that. Jay Wilding, HMO. Oh, Jay, nice to see you after yesterday's conversation. Hopefully you've actioned all of those points on my email yesterday. Not expecting you to have done so, to be fair. And yeah, so Resi starting out property, sorry for the telegraphic message, will improve. Happy Rooms, don't worry, that was just me reading it wrong. So I'm to blame. No dartboard behind my neck right yet, but I'm sure by the end of the day, that will improve. So let's move on then. So again, don't forget to press that subscribe. So like buttons, I've seen 9. There are a lot more of you on there. So smash that like button, press the subscribe button whilst you're here as well, so I can notify you of any comments and carry on those comments as we do. So let's go to stamp duty land tax. So, wow, I'm pretty all fired up, as Marshall from Paw Patrol would say. Not many of you would understand that as single people. Anyway, so let's move on to stamp duty and land tax. So we talk about the foreign surcharge. So if you're a foreign person investing in residential properties, you now have an additional 2% SDLT surcharge. The higher rate of SDLT is 3%, which we know kicks in after you buy a residential property investment of £40,000 or more. You have now a total surcharge in place if you are a foreign person investing in property. The question is, what is a foreign person? Now, that sounds like it's an obvious answer, but is it? Because if you are a foreign person owning a UK limited company that then owns a UK property, does that constitute as a UK investment or a foreign investment? And indeed, the law says foreign persons. Now, persons could be deemed to be a company, but time will tell where the government goes with that. It's very much difficult for solicitors to understand who the majority shareholders are and where they're based. So time will tell. But this gives you a bit of a flavor for now. So if you want to take a screenshot, do so. This is the kind of rates that you can expect to pay on residential with high rates in the middle column there, and then the residential with the foreign surcharge as well. So you can see the kind of table view, and it is a scaled charge. It's not a kind of, at the bottom, it's not 17% of the 1.5 million. It is the excess over 1.5 million, but 17%, wow. I think majority of people that are buying properties probably will be the ones that will buy properties between 100,000 and maybe 300,000, maybe 350. Once you go over that level, I do not think that you make very good return investments. You may make good capital growth, but not necessarily a return on investment, unless you've got a holiday let and it's a block of flats, as an example. So do bear that SDLT in mind. It's a lot to have. There is something called chattels. I was wondering what the name was, and it's right there in the circle. Can't even read. But chattels are things that can help you reduce the SDLT, or stamp duty land tax, because that charge is based on the bricks and mortar value of that property. I've just picked up my drink and I'm about to put it down without drinking. So let me just take a sip here. You'll notice I didn't slurp. I have golden rules of doing videos, and slurping really is not good on a microphone, which is right next to me. So I will do my best. I might burp. That might be true. Anyway, so chattels. So if you take a house and you turn it upside down, because like me, you've been to the gym, not anymore. But if you did go to the gym, you could pick up a house and you could rattle it. Things would naturally fall to the floor. And those are deemed chattels because they are not affixed to the bricks of that property. So you've got soft furnishing, curtains, carpets, beds, dining table settings, all of those kind of good stuff. Basically what it means is when you're buying a property, you can say to the seller, look, I wish to buy the property and I want to buy your things because you're moving out, you're downsizing, you don't just need all these things. You don't want to go to the tip and empty the property. We'll do that for you. But could we agree to keep the value of the purchase price at the same level? But we agree now that we will buy the chattels from you. And if they agree to do that, you'll notice that I've got chattels says SDLT of the title. You've got a house purchase price of £350,000, but in the second example, we say you've got £20,000 worth of chattels. Well, if that is the case, you would then find your SDLT rates being reduced. I've just based this on the 3% SDLT surcharge, not the foreign charge here. But straight away, you can see yourself that you can save £1,600 worth of SDLT just by that simple technique of using chattels. And all you have to do is speak to your buying solicitor to make sure that the selling solicitor identifies the chattels within the sales agreement. You also need to make sure that the SDLT calculation is done excluding the chattels, because I have seen so many mistakes by conveyance solicitors that just tap away onto the HMRC generic SDLT calculating tool, which is generic. It doesn't take into account chattels. And if you're not careful, you could overpay SDLT. And that's why we have got a service talking about people that have overpaid on SDLT. Unfortunately, you couldn't backtrack it. So if you said, well, I bought chattels after the event and it's not being written down in the completion agreement, forget it. It's too late. But you can remember that for the future. That's what I would say. Stamp duty, land tax, where could you save more money? Well, you could have non-residential rates. Non-residential rates, we talked about whether you buy office shops, warehouses. I'm not going to go into that much detail. But if you bought 6 or more residential property investments in one go, then that will be deemed a non-residential transaction, which, go figure, you've got one seller that has 6 properties, and you then say, well, that's a non-residential transaction. I'm putting all that together and I want to reduce the SDLT. You can. Guess what, though? The solicitor in question will just go on the website and use the generic thing and forget to type in that it's non-residential. So you have to be very careful with that as well. You will also pay non-residential rates of SDLT if you purchase a shop or a restaurant on the ground floor, for example, and then you have a flat above it. That is called a mixed use property. And that's where I think where most investors don't take advantage. I am seeing personally the fact that people are becoming more urban living. So interesting enough, and it's just popped into my head here, but let's imagine that you have a little supermarket at the bottom and then you build flats above it, and you own the business on the supermarket itself, then you've created yourself a business income stream, and you then got the building above, and you've also then got less SDLT to pay as well. I mean, how brilliant is that? Have a business as well as residential investments. Something to think about, I think. And stamp duty land tax, as it's showing there, is the non-residential SDLT compared to the residential SDLT is a lot lower. So if you look at the 1.5 million, most people aren't going to do this, but it's 5% versus 15%. And we've got, oh, by the way, if you're listening to me and you're thinking, crikey, when's he going to shut up? I will be keeping quiet for about 10 minutes. I'm not going to just sit here and be quiet. I'm going to go get coffee, okay, within the hour interval. So hoping we'll get through some of this good stuff. And then we can all take a break. You can say, well, thank God he's shut up for a second. And then you probably need to get to your kids who are annoying even more. But anyway, you can have a break. So that will happen at the hour interval. I've just gone back quickly on that. So back to my point of, if you're buying a property for about £100,000 and it's a non-residential, you'll pay no SDLT. So commercial properties, non-residential, no SDLT on a property that is less than £150,000, which is certainly something for you to consider when you've got 5% banded rate on the residential element. So what I want to do is show you a house. Now, this is taking to an extreme, because I did say you're not going to be buying a property for £350,000, or that £350,000 is what you will buy, not much over and above that. But I wanted to show you this anyway, so you could see the type of SDLT savings that you'll have. I did this because it's pretty much halfway through. So if you buy a £600,000 mixed use property, so you've got the shop and then a flat above it for 600,000 versus just a house, you're pretty much halving your SDLT liability. So it is worth you thinking about this. And obviously the mixed use properties is not subject to the 3% SDLT surcharge or the 2% foreign surcharge. And I know that Teo is probably online, and we talked about different types of property investments. Maybe mixed-use properties, Teo, after our conversation, is something that you should be looking at in the future, especially if you've got holiday lets. You could have shops below and then holiday lets above. That would work really, really well. All right, so if you are finding this useful, don't forget to type in the smash that like button, press the subscribe, and drop me with any questions that you have in regards to stamp duty land tax. Has that been useful? Tell me so, if it's been useful. Have you found ways of reducing SDLT? And in fact, can you see ways to reduce SDLT in the future? Please type in the word yes. If something has been helpful, type in yes, maybe then with a dash, whatever it is that I've been able to help you with to reduce SDLT in the future. And if you put in no, maybe put in no dash you suck. That'd be quite cool. Maybe not. The YouTube algorithm may not like me for that. So if you could type in yes and why, how has it helped you, or no, and why not? That'd be great. So let's have a look at some of the questions and comments that have been made. Wow, there's a lot more that's been happening here. So I'm pretty pleased about that. Okay, what is GAR? Someone's asked. GAR stands for General Anti-Abuse Rules. So that's where people are trying to take advantage of using a limited company structure to get a tax advantage. So you might have a property in your own name, Rebecca, but then you move the income into a limited company, which is unfortunately against the law. So you do need to worry about that. Karim has asked a question about GAR as well and what we could do about it. I will be going through that later on, so that's absolutely fine. Louise has answered the question to Rebecca. Sorry, Louise. We need an update SDLT calculator for foreign surcharge. That is a very good point. I will be creating a new template for things like capital gains tax, SDLT for the new things, and I will be putting those onto YouTube so people can use those, and it'll be a guidance of how to use them as well. So make sure that you do tap into that. Just starting off about making my first transfer into my bank account. Is there a tax implication? How do I make the transfer, whether I deem it to be a direct loan or an equity injection? Teo, honestly, that's probably more detail that I can go to right now. Great question, but I would say make sure that you click the link on the welcome email I've just sent to you last week to book that tax call as soon as you can on Monday or Tuesday to get that tax question answered. Some accountant mentioned that I should transfer £100 first. Doesn't really matter, to be fair. I don't think that makes any sense at all. It doesn't matter what you transfer. It is hard to find a solicitor with good property knowledge. No, I agree. Sam Hawkins. Okay, I'm sure that Sam stands for something else. So Sam Hawkins was great. Vili Chung is great. Shimon Rudich, great. There are plenty. So make sure you say hello to them from me. So let me just go through it. So yeah, very good. So what's the question? So clarifying what clearly is out there into those facts. Okay. Quex has asked a question. Hi, Louise. Is there any circumstances where additional stamp duty is waived, reduced for a company who owns X or more properties? Well, I mentioned about if you buy 6 or more properties, then it's non-residential rates. If you buy 2 or 3 properties, you still can get an averaging of SDLT, which could help. Let's imagine you had a property of £40,000 where there's no SDLT at all, which is a bin lid in London, I think that's phrased. But if you've got a property of £40,000 and a property of £400,000, when you're doing the averaging of those 2 property values of 440,000, well, that gives you 220. Well, look at my maths go. Hey, so that gives you £220,000 averaging, which brings down your SDLT liability on the banded rate only. So do note that. So it can certainly help you. Lucas said, if I sell property, use a holiday let for your first few years, where the buyer is paying non-residential SDLT, is he able then to convert it back to resi? If you're buying a holiday let to claim non-resi, you won't get it. Because holiday lets is still deemed to be residential in nature, unless there is some case law, which I talked about on a previous video, whereby you buy holiday lets and it's a genuine guest house or bed and breakfast, which means that the SDLT can be lowered. But typically, SDLT is residential, even if it's holiday let. So you don't get any savings on that at all. So Paul's asked a question. Claiming full interest relief to buy-to-let property is when you have 4 properties or more and you cannot claim the interest rate. To be fair, Paul, it doesn't matter how many properties you have, you cannot offset the income, the mortgage interest against your property income at all. We will go through that later on section 24. So I can see that Louise is doing a great job answering Taya's question. That would require a lot of explanation, and I'm glad that she's doing that. Forex Coach said we are covering grants to hospitality, 8% guarantee from Gov. Great question, Forex Coach. I did that last night on another video, which I do every weekday at 8 p.m. Again, a YouTube live. So do make sure you go onto that to see about the 80% wages that will be paid to not just hospitality, by the way. That is to every small business, charity and non-profit. So I did an awful lot of research last night. Guys, you wouldn't believe how much time this all takes up. But I'm hoping that it will certainly be worth it. Okay, let's get back into it. So if you want to book some time with me, maybe take a screenshot of this. It talks about, there are links below this video, so you can book some time with me. You could get an hour of my time for £300 using the code YouTube25. If you want to speak to the other accountants, you can do so. Again, use the code YouTube25 and you can get Lynette, Co, Nadeem, Razik, for about £112.50 or something like that. It's amazing how these numbers just off the top of my head, just awesome. Here's the pop on the microphone, by the way. So yes, you can get my time for about £300 if you want to help with this specific. If you're a client, by the way, you'll get to have time with Nadeem unless free of charge anyway. But for non-clients, you could still get some support with all these things. It does say break. Now, that's really odd because I haven't really covered that much. So if it's okay with you, I'm going to ignore that. And we're going to trundle through some more content if that's all right. If you need to get a coffee, then please do. Don't put your hand up. I can't see you. So just go. If you want a toilet break, again, don't shake legs like my son does. You know, just I need to go to the toilet. Do you need to go to the toilet, Hugo? No, you do need to go to the toilet. Just go. Okay, so please don't shake your legs underneath the table. It makes a rattling noise. It's not pleasant. It's not very nice. So please do go to the toilet and get yourself a drink anytime you should wish to. I have this thing which looks like a drink for rabbits. Makes the same noise. So yes, I'm good. So if you do need to get yourself a drink, please do so. We will disappear for a 10-minute break, but let's get through some of the content, shall we? Let's talk about section 24, because I see people asking about that already. So let's talk about that, shall we? So are you affected by section 24? Again, I appreciate your fingers are getting a little bit tired. Don't sue me for RSI, by the way. I have no insurance for this kind of thing. But if you can type in there, say, are you affected by section 24? Type in yes if you are. Have you seen a tax change on your self-assessment, or no? Or even, I don't know. And by the way, it doesn't matter if you don't know, because that's why I'm doing these workshops for you, to get an understanding if it can affect you. So type in yes, section 24 does affect you, no, or don't know. And I'm going to answer that for you with a no, because my properties are inside a limited company. Section 24 does not affect properties that sit inside of a limited company. So genius, right? So let's have a look. So happy rooms, yes. Snake from Slytherin. Let's have a look. Oh, by the way, that's Lucas has just said no, move my properties to a limited company just before it was introduced. Brilliant. Also legendary. Not yet for Rebecca. I see that Rebecca's asking another question, so I shall let Louise crack on with that. Happy rooms, yes, but it all good planned for. Don't know. So Jay, don't worry. For yours, you're doing rent to rent. So interesting enough, it won't affect you, but it could affect your landlords. So it is worth you finding out that. No, use a limited company. Brilliant, Sarah. It sounds like everyone is moving to a limited company at some stage in the future. I have half in the limited company, half in my personal name. Okay, so let's have a look, see what we've got going on. This is a lot of data, but what I want to show you here is that all the numbers are the same. It's not a mistake. I purposely did this way, but it's just showing you all the tax years. So 16-17, just as I think, is before section 24 was introduced. 17-18 all the way through is when it's been phased through, and then the year 2020-21 is when section 24 is in full effect. You'll notice none of the numbers are any different. The real profit is still remaining at £3,000. So why am I showing you? Well, what I'm going to do is I tried to do this highlighter pen and it really screwed up. What I want to show you is the real profit across this hasn't changed. That is going to be staying static. Now, what you'll notice that the disallowed interest is showing you here. So 2016-17 is where I'm going to be focusing my efforts today, versus 2021 when the mortgage interest relief cap is in full effect, which is this tax year coming up now. You'll notice that the taxable paper profit, which is not real profit, goes from £3,000 to this huge amount of £26,000, which is a lot of money, I have to say, based on the tax that you'll have to pay. Most of you have just fallen off your seat because these numbers are very, very scary indeed. But going on from that, what I want to show you, you do get a misnomer out there, is that you don't get any tax relief at all. And that's not true. You do get a tax reducer, and it's 20% of whatever the mortgage interest cost is. So if you are paying £1,000 more worth of mortgage interest, you get a £200 reducer against your tax liability. It's not the full £400 if you're a high rate taxpayer. So you're getting half the tax relief in effect. But what you'll notice is that the net tax on this particular situation is now, and I'll just talk about high rate taxpayers, because that's really who it's affecting in the majority of cases. So net tax, you'll notice as a high rate taxpayer, you're paying a shed load more tax, compared to 1,200 in 2016-17 versus 5,800 in 2021. It could, in fact, show lots of people that they are paying more tax than the profits they are indeed making. And if you recall from the previous slide, the amount of profit you was making was £3,000, but you're paying £5,800 in taxation. That tells you a lot. Now, typically, this is going to affect people that are in London that have big properties or flats and very expensive. And the mortgage is very hyped up as well. Maybe they've got residential rates, or they've got a mortgage buy-to-let. But the fact that they've now vacated that property and now they are having to get clobbered with this Section 24, pretty much would say that they're in trouble. So you are going to see lots and lots and lots of landlords in London with problems on their hands. And there is no real solution for them as such. But we'll go into exactly. This slide, really, all of this is doing is just showing you that the tax on profit is 40%. Obviously, as a higher rate taxpayer in 16-17 before Section 24 came into play, then you've got 40% tax liability. That's pretty obvious. But if you move into 2020-21, you'll notice that the amount of tax now is 193% of the actual profits. That's scary. And we have had one particular client, I've never seen it higher than this, was 155%. Okay, so that was a real case story. And then obviously they'll be paying more tax in the future as well. So what did they do? Well, stay tuned and I'll go through some of the Section 24 mitigation factors. Right now, and interestingly enough, I've just noticed that this graph probably needs to be updated given the recent changes, because that blip is obviously now lower than the 0.25%. But at some point in the future, Section 24 will be a compound issue, because you're paying out mortgage interest, but you don't get the tax relief. And mortgage interest at some point in the future, whether it's 5 or 10 years time now, will go up. Maybe it won't be this 7% that we saw here, but it's certainly going to be going up at some point in the future. And as such, who is going to be making more money from residential property investments if you have a mortgage? Is it the banks and HMRC, or is it you? Well, my bet it's on HMRC and the banks making more money from the time you spend investing in residential property investments. So it does bring to a question in my mind is, why have a mortgage? Because if you don't get the tax relief, and interest rates will go up at some point in the future. Right now, you've got to get a mortgage. They're so cheap. You may as well leverage. But once the interest rates go up to 5-6%, I'm kind of saying, well, maybe that's the time to pay down those mortgages and benefit from Section 24, because it's not going to affect you anyway. So do have a think about that as we go through. I did say, what will the interest rate be in 2021, 22? I think we know now it's less than what it was before. So it is worth taking advantage of that scenario. Let's talk about mitigation factors and things that you need to think about in the future with your property strategy going forwards. I think what I would be saying straight away is you could be buying in commercial properties. As we mentioned, warehouses are going to be huge in the next few years. Storage, self-storage or business storage, huge in the future. Why? Well, because we're going to more online shopping. So places like Amazon are going to require more space. Now, I appreciate they may buy their own stuff, but you are going to find small independent online distribution centers that need to have a warehouse or rent a space in a warehouse. That could be a real good killer. Holiday let service accommodation, not right now, because the coronavirus is shutting them all down, as we can see. But in the future, maybe that could be more popular than residential. Section 24 doesn't affect holiday lets. You've got rent to rents. Now, who's paying the mortgage interest? Not you if you're doing a rent to rent, Jay, but the landlord is. So Section 24 won't affect you because you don't have to offset the mortgage interest, but the landlord may if they have a mortgage. So you do need to speak to them and say to them, well, hey, have you got a mortgage on your property? Now, they may say, well, you're a bit nosy, aren't you? And that's fine. You might just need to apologize, but explain to them about Section 24, because I rather suspect that 60% of the population of landlords still do not know what's this Section 24 is all about. So explaining the situation may put them in a position where they sell the property. And rather than sell the property to a stranger, why don't they sell the property to you? And you agree a deal to take this tax burden away from them. Open the conversation and see what opportunities may exist for you. Repayment of mortgages, as I mentioned before, people used to use mortgages for capital growth, leveraging of debt. Now, leveraging of debt still very much applies, especially with coronavirus and the reduction of the Bank of England interest rates. And if you're on a variable rate, you really are going to be quite happy. But in the future, when interest rates are higher, then maybe paying off those mortgages. Going back to my point, actually, the whole premise of using a buy-to-let mortgage was leverage. So you could take, instead of investing, let's say, £100,000 into one property, you could get 4 properties and invest £25,000 a time, which comes back to your 100,000. But instead of just having one unencumbered property, you've got 4 buy-to-let properties. And if capital appreciation takes off, then you are clearly going to benefit from using leveraging of debt. But the question is, how is property values going to go up more than it is already? We're not in the 2000s or 1990s where property prices were skyrocketing. I think we've had that, and we will get that again at some point in the future. But has anyone got a crystal ball, especially in these times, to say when property values will double in 10 years? In Nottingham, property prices have not doubled for at least 15, 20 years. So really using debt as a way to get capital growth doesn't exist as much as it used to. So do bear in mind that there are a lot of courses still saying use buy-to-let mortgages, but then Section 24 impacts you so severely that you kind of think, but that seems to be an old strategy that people are still spinning to sell courses, but may not be relevant anymore. So you do need to be careful when you're getting into it. Losses on your property portfolio. You may have losses on your property portfolio right now. You're thinking that Section 24 is not affecting you because your losses are just being eroded, but they're being eroded very, very quickly. And once those losses have been utilized on your self-assessment tax return, then unfortunately, you're going to have a huge hike of tax that you was not prepared for. And it could in itself give you a financial headache because you didn't think it was going to happen to you. You didn't understand the magnitude of it. And that's why for many years now, we've been doing a forecast for our clients to say, this is your tax position now, and this is your tax position after Section 24 is going to be in full flow. And we're doing that for this year again for all of our clients. But if you're not doing that, how do you know how Section 24 is going to affect you? Make sure that you work with your accountants and tax advisors to build that forecast for you. Using limited companies, like me, like many people that I've just seen on this chat already, are using limited companies because Section 24 does not affect you. And I used to say that the limited company interest rates for mortgages were higher, maybe 1.5%. Well, actually, I'm seeing such competitive numbers now of 3.5% inside of a limited company. I mean, boy, that is cheap. And I will suspect that that market will be even more competitive in the future. So do bear that in mind as we go through. Self-performing assets. So one of the things I always talked about is that you might want to sell or convert your properties. So we talk about residential tax now in 2021 on real profit, £3,000. You may make the same amount of money on the holiday let by converting the buy-to-let from residential to holiday let, and you pay 40% tax. But look at the amount of tax that you've got to pay, 1,200 based on a holiday let income of profits are 3,000, or 5,800 having a normal buy-to-let residential property. Commercial properties, if you had a commercial property in your own name, which you converted, again, you could have real profit £3,000 and have net tax 1,200. Well, how do you do that? Well, A buy-to-let property, as I gave an example earlier, could be converted to a shop if it's on a corner plot. It could be converted into a dentist, an office, you name it. You can convert good buy-to-let properties that are on corner plots that have got decent car parking spaces into commercial properties. Now, I appreciate it is a new market, but is it better to go to a market whereby you're making money rather than losing money? I'll let you decide on that one, maybe. And the other side to it is, let's imagine you now have 3 buy-to-let properties. And the one thing I would be saying to you right now is just have a look at your interest rates. Now, you're going to see that these properties here, I've just done a mix and match, okay, in terms of properties. But what I wanted to show you is that you could have properties with different buy-to-let mortgage interest rates. Now, especially with banking interest rates being so low, is it a good time to fix your mortgage interest for a long period of time in the future? If you're paying 5%, you're overpaying on interest. You need to renegotiate that and lower it, especially in these times. You might have a contract that says, well, you've got a term of 3-4 years, but actually now it's everyone's game. I think contracts are there to be ripped up and to really negotiate hard with buy-to-let companies and say, you know, while we're in coronavirus, I need you to help me. But nevertheless, you should be looking at your interest rates simply because you're paying out mortgage interest more on some properties than others, and you're not getting the tax break either. So this is kind of some of the things I wanted to show you is you could be in a position whereby your profit is hemorrhaging because the interest rates may go up in the future, or you're simply paying high mortgage interest rates as it is. So you've got to look at your properties. Now, if you looked at this scenario, and I don't know how many people will do this, I understand it that people think that numbers are there for the accountant to do the tax return at the end. No. Those numbers that you need to do on a monthly, quarterly basis is there, whether you use QuickBooks or Xero online bookkeeping services, is to help you manage your business. Now, oh, sorry, I shouldn't clap, it's a bit loud. But if you're running a business, if you turned up to your managing director and they said, well, can I have my financial report? You just say, yeah, well, my accountant will do it at the year end. You'd be fired. So I think what I am seeing out there is a lot of, oh, sexy networking. I can buy a property for below market value at 25%, put it on Facebook. It's great. I'm not sure why I've gone into a bit of a Chaz and Dave on that one, but you know what I mean? It's people want to do the sexy stuff. They want to be proud of it. They post pictures of their rooms on Facebook. Look at this. How brilliant is it? But then you say, well, are you making any money? I go, I don't know. My accountant tells me, who probably knows less than you. So do make sure you get a bit more savvy in your business. You're in this game, as a reminder. I feel like I'm lecturing you now. But you're in this game to make money. Now, if you don't do your profit and loss by property each month or every quarter, how do you know if you're making money at all? I don't know. You may as well stack shelves at Tesco if you're going to take that approach, because I guarantee you'll probably make more money. That's a fact. So make sure that you look at your properties and your financials of those properties and do something about it. Now, I'm not going to go through these slides, actually, because it's a bit overkill, I've got to be honest. But one thing I did want to show you is that you could be in a position whereby your profit on property 1 is making a loss because of section 24, and you've got this net tax to pay. So it's a percentage of profit is infinite because you're making a loss anyway, but now you've got this tax liability. So you need to do something about it. What do? Sell it or convert it? Up to you, but do something about this property. If you're not looking at these numbers, you won't know how it's affecting you. Month by month, quarter by quarter, year by year. Is this property making me money? If not, get rid of it straight away. Don't even think about it, or convert it to another type of property. Property 2, obviously the net profit is net tax, 239%, not very good either. They pay more tax on that than you have the profit, gets rid. Property 3, however, section 24 still high at 58%. Again, you might want to think about, well, do I keep that? Do I pay down the mortgage? Can I increase the rental income on that property? Doing something, but look at the total in this regard. Someone is paying £5,400 on a profit of 778. These are real numbers. These are actually what people are paying out there. It may be numbers that you're paying, but haven't worked it out yet. Work with your accountant to make sure you understand where it's going. So this is where I'll say sell property 1 and 2. You might want to keep property 3, but just increase the rent so that the net tax position isn't going to be as bad. And by the way, if you dispose of property 1 and 2 and your income falls below the high rate tax band, then all of a sudden you may be in a position whereby your tax position on property 3 is just 20%. So, it could be a compound effect of selling 1 or 2 properties on the 3rd, 4th, 5th property to make those even more money. Again, guys, this is now the time for you to smash that like button, press the subscribe button if you haven't done so on my channel, and to ask any questions that you have, which Louise and I will go through in a second. But can you find ways of, by listening to what I've told you today, can you see ways of reducing impact of Section 24, even if you're not going to act on it, but can you see how Section 24 might be disapplied or mitigated, because you can then tell other people, which is always useful. So if you can see ways of minimizing Section 24, type in yes or type in no, followed by I don't understand this. And then hopefully Louise and I will come to some support, and I'll stop stuttering at the same time. So type in the word yes, no, and then I will come on to that. Louise has just typed in soapbox. Thanks. Yeah. And why not? It's my show. Do like it's my ball. So yes, so it is. I'm going to do it. I'm going to go on my soapbox. In fact, this soapbox is not high enough. It needs to be 20 foot tall. Why? Where is my soapbox? So let's just go through some of the things that we had. So Happy Rune said, you mentioned that pains that landlords are going that are capital gains focuses. Can you expand on the pains that such landlords are facing and what options do they have? I've talked about that the pains are that there is no more capital gains as much. So people used to buy properties in the 1980s, 90s, and the capital growth used to be high. Then make lots of money using mortgages as leverage. I don't see that happening as much going forwards. And that was the only thing I was talking about. Okay, so let's just go through Happy Roots. Awesome, cool. Hopefully it's helped. Louis said, and could use equity from sales prop 1 and 2 to pay down mortgage. Absolutely, yes. Louis has mentioned if you sell properties 1 and 2, you could then use that money to pay down the mortgage on property 3 and have all of the tax being just at 40% as high rate taxpayer, or even less at 20% as a basic rate taxpayer, because you're not paying any mortgage interest. You are making the money, not HMRC, not the banks. So is it better to have unencumbered properties? I'm going that way, I've got to be honest. I know a lot of people will focus so much on return on investment, but having a return on investment on £200, even if it's 100%, well, that's rubbish compared to making a 10% return, but you're making £2,000, right? So you go figure. Is it return on investment or is it cash that you want through the door? ROI is a percentage term that's just overused and abused, and I just don't think it's relevant all the time. You've got to look at how much money you're actually making to make a decision on that. Okay, Happy Runes. Simon couldn't be more right on some of the amazing deals seen on FB or social marketing platforms that do not perform well after all. No, yeah, it frustrates me. I think people go to these courses and then think that they're going to be millionaires because they've been on one course and they think that's their education done. Well, unfortunately, I've been in property for a long, long time. I've got the scars. I've got one right there. That's from a property. Actually, it's not. I scrubbed that. That's not from my, that's from something else. So Jay's asked the question, does the, oh, sorry, Curran says, I'm using a deed assignment to minimize the impact as my partner in the homemaker. So yes, you can do that. That's where you transfer the income from your property using a deed of trust. And I've done videos on that, so do have a look at that. If you're a high rate taxpayer and you've got a stay-at-home wife or stay-at-home husband, then you could transfer the income to them, and then they could, get that done there. Louise, just bear in mind on this, we are talking about high rate taxpayers. Maybe I could stay at home doing these videos and not earning money at all. Maybe that we could. So do think about that, Louise. Paul Preston. Wow, I've got Paul Preston on the site here. This is awesome. This is made me smile like a Cheshire cat. So Paul's asked the question, insight into how to use holding company if they don't make profits. A bit more detail about using holding companies, got to be honest, Paul, but I will be doing a new tax course probably in next month, because I'm going to do these monthly, and I will be talking about tax structures using companies. So that'll be for later on. Bhavesh instead, I hear a lot of people using hybrid structures, LLPs and LTDs. Don't get me started, Bhavesh. I've already said don't like them. So no, don't, please. My face will turn orange, red, steam. You get that picture, right? I'm not a fan. Louise just said nope. I think that she's answering the question of me staying at home and not doing anything apart from these videos. Oh well, you have to ask. The question is from Teo. Question: can I claim expenses paid 3 years ago on the company remain dormant? Can carry over their expenses? My view is that if you, Paul Preston, you are very welcome, my good buddy. It's a pleasure to see you on there. I'm surprised, I have to be honest, only because you're a legend, and why are you on such a lowly channel like mine? Sorry, Louis says, let's say I left you at home, so you knocked down a wall I didn't want knocking down. No, you can't prove it because we don't have that house anymore. Go figure. So Terry's asked the question, can you carry over those losses? Yes, you can. Those losses can indeed be carried over. You just need to bring the receipts into your account, date them as of the new date, because ultimately the year-end accounts probably were wrong because you had these expenses. But I would say just put them into the New Year's accounts. And Teo, you're a client of ours. We will be helping you through that process. So never fear, for Emma is there. Emma Pincott, that is. So yes, we'll do that. So let's just go through consultation. So if you want to book my time, you're not a client of ours, that's fine. You can book some of our time, whether that's me or Lynette or Nadine, and make sure that you get as much tax support as possible. If you're a client, it is worth you booking a tax call to talk about some of these matters that we've raised up. We're going to talk about partnerships, but now is, what time is it? Just to prove that this is live, obviously. It's now 10:07. So why don't we have a break? So it's now 10:07. I'm going to give you 8 minutes. So let's get back here at 10:15. Now I'm going to see if my phones are synchronized. So it's 10:07. Let's carry on. I'm going to mute my microphone, switch off my camera. I'm going to do the little boys' room and get a coffee because I really need caffeine up. And we'll anticipate at 10:15. So I shall see you back at that time. Okay, welcome back, everyone. Let's carry on our session. Hopefully, you have got yourself a nice coffee. It won't be a Costa or a Starbucks because, well, they're closed. So if you'd like a coffee, I can get them delivered for you for about £99.95. Actually, no, let's go with £74. You know, that's the new marketing technique, isn't it? So £74 and the coffee is yours. Might be a bit cold. Anyway, so let's talk about partnerships then. So when can a partnership be useful? Well, let's just go through some of the details then. A partnership could be between a mom, dad, and adult children. You might decide that property investing, property development could be for the family as a whole, which could be a good way to make money and make lots of time together as well. You could be a genuine legacy to pass down to the family as a whole. And we're seeing a lot of that's going on. Before we go into the details, what is a partnership really from a tax perspective? Well, typically not a great deal. I do hear a lot of things about LLP structures because they give you these kind of IHT things, which actually HMRC are now pushing back on to say it doesn't get you an IHT break. People are also saying that an LLP structure gives you legal protection. Well, surely you've been having properties in your own name for such a long time. What does it matter? We've never had legal protection before. So now we've got these LLPs. What it is great marketing. That's what it is, great marketing and a lot of money. But really, is it having that much value? I don't see it, if I'm honest. And I appreciate that is quite controversial. And I appreciate I'm going to get someone to give me a thumbs down on this video because of it. But ultimately, I need to just tell you how I feel about them. So the thing is that a partnership goes from a tax return, one-page color, which is salmon color, I guess, or pink. But it moves from that page, which you're currently filling in on your self-assessment tax return for your property, and moves over to a green page. So nothing really changes on the way that you do tax returns whatsoever. There is something called Partnership Act 1890. Don't read it, really boring, have to say. I've read it, boring. But what that act says, to be a true partnership, not sure what true partnership is, but a true partnership, it is two or more people working together. Well, clearly, I have had someone say, can I be a sole partnership? Clearly, they're not married. So ultimately, you could have a position whereby you got two or more people work together. You could have children in there, but adult children, please. There are tax issues with having minors as a partnership. But adult children that are involved, you could have family members working in a partnership with a view to make profit. That is the key thing, a view to make profit. If you can do that, if you can prove that you're there to make profit, you've got a couple of people, great. You must be a true business. What does that mean? It's a true business. Well, isn't property a business? Well, according to HMRC, no. If you are owning property investments and getting a return from that, just note the word I've just used, investments. They do not see it as a genuine business at all. So do bear that in mind. Which basically means you must manage those tenants. So you cannot use a letting agent to be getting the tax advantages of using a partnership. And by the way, it could be a simple partnership, which I'm describing, or the overinflated price of an LLP. So ultimately, you've got to be managing those tenants. Now, some of the other things I'm going to describe later on. Well, one of the things I've not put on here, but I would suggest you have it, is a written agreement to form your partnership. And the partnership really is designed to be another tick in the box. Now, I know that many accountants out there, and they are right in what they are saying you don't need to do a partnership tax return, you don't need a partnership agreement. But in my view, is it not better to have ticks in boxes to stop HMRC from prying too much information and saying, well, you haven't got this, you haven't got that, and then going through court? Isn't it better to say, well, here's my partnership agreement, here's my partnership tax return, here's how we split the profits, here's what this person does, here's what that person does, all contained in this one single document, and you say, cheerio? Or do you want to be embroiled with the questions that HMRC can set, simply because you don't want to do a partnership tax return and you don't want to do a partnership agreement because your accountant said you don't need it? I get it. You don't need it by law, but it is a safeguard. It is a way of protecting your time from the annoyance of HMRC questions. It's really up to you. But it's my view. I like to be bells and whistles and ticks in boxes. I just like ticks, not those type of ticks. In fact, got one there. So let's move on from that to how partnerships can really help. Let's imagine you've got a husband and wife, James and then Sally. So Sally is now working full-time in property. She was a high rate taxpayer herself as a consultant, but she's decided, well, actually, I can do this better than you, James. You stay at work. So he's now got a salary job, and on away she goes. Now, tax status, James is a high rate taxpayer because of his job. Sally's left that job, so now she becomes a zero tax man. She has no form of income. Investments in properties use salary, none. So basically what I want to focus on really is the fact that he's used all of the income from his job. And what I want to do is taxable property income on self-assessment. So let's imagine that he had all the properties in his own name before they got married. Now she's working full-time in property, but she's getting none of the income. Now, you tell me, first of all, from a commercial point, he's working in a job and he's now putting on his tax return, he's getting all of the money from property. But Sally is doing all of the work. That doesn't sound right from a commercial angle, never mind anything else. So he's got this tax liability that he doesn't really want. Now, one thing I would say to you is, I've just noticed my tax number is wrong, by the way. Clearly, you'll be able to see that. But its tax on profits is more than £3,000 on there, but you'll get the picture. He's got a tax position to have. Sally has no tax. What can we do? Well, this is where your partnership agreement can work for you. You can set up a partnership agreement, document it, get a solicitor to sign it off, and you'll be absolutely fine. And basically, you say, share the profits as you deem correct. Well, what does that mean? Well, in my view, I would say just have the profits as 50-50. So you have all of this kind of partnership profits coming out of your partnership property investment activities. It gives you this profit split, which you just say is 50-50. Now you're kind of thinking, but if I'm saying 50-50, how does that really work in regards to the making someone tax efficient? Never mind giving Sally what she legitimately deserves, which is money from the work she does. Well, okay, we understand that. But what we could say is that we could look at the profit split and then say, well, we could pay Sally a wage, a deemed wage before the split. So you could have profits of, let's say, £20,000, but we're going to give Sally £10,000 as a deemed wage for the time that she spends legitimately working on the property. And you can have that in your partnership agreement to say the profits will be split 50-50, but Sally will get a deemed salary for the work she does. And that might vary from year to year. And you can put that on your partnership agreement and there's no issues on there, provided she is legitimately doing work. Managing tenants, as an example. Listing them on Spare Room or on Rightmove if she does her own. She might be doing the administration, the ASTs, the inventory checks. She could be doing all of that, and she deserves to be paid for that work. So ultimately, what we're saying is, well, all we're doing is shifting some of the income that's been allocated to James, which was 100% of that 12,000, and we're going to start shifting it now over to Sally. That is a principle. Now, in the future, you might say, well, you can incorporate your property partnership business into a limited company. But here's the thought. have you thought about using this partnership structure and not moving it to a limited company at all? It is entirely possible whereby people are using limited companies, and I'm going to get into the limited company subject later on, but people are jumping in saying, I need a limited company. In fact, I have clients that have set up a limited company even before they have bought a property, thinking about buying a property, but just come to us and said, here's my company. I'm like, but you don't have a view of if you need it. Maybe there are alternatives. Now, I have a long list of mitigating Section 24. Partnerships is pretty high. Using a limited company structure, pretty low, actually. And I'll give you an example. We had one particular client who's been with us, and we said, well, are you going to be staying in your full-time job? Now, they were husband and wife, both worked in London, very successful what they did. And I was like, it was, yes, we're going to stay in our job. Well, fine. Use a limited company. Well, 2 years later on, well, actually, I've given up work. My wife is staying at work. She loves what she does, but I don't like it. I've had enough of the banking industry. Tao's listening in. Not, by the way, it's not Tao who's leaving his job, by the way. So before we start any rumor mills, it was someone else. Okay, let's call him Jed. So Jed now has given up his job. And by the way, equally, that's really, oh no, this is really bad. I'm digging myself a hole, if you can see it. I'm kind of getting lower and lower into this hole. It's not even Jed. Jed's just a fictitious name. Okay, so let's just call him Jed. It's not his real name, just Jed. So Jed now has given up his job 2 years after he set up a limited company. And now he has no income. And he's saying to me, well, how do I extract money out of my limited company so I can have a lifestyle? I'm like, why did you even set up a limited company if you knew that in 2 years' time you was going to leave your job? Because the buy-to-let mortgage interest rates would be lower in your personal name. And I appreciate that you have Section 24, but you are being taxed in the company and then extracting money out of the company. You've got further tax to pay, which I'm going to give you an example later on. And you've got the accountancy costs as well. Why did you do it? And we have that situation time and time again. So don't jump into limited companies, because partnership could well give you the solution you're looking for without creating this crazy LLP structure, which costs you lots of money because to pay for their marketing expenses, but ultimately you might not even need it. So what I'm saying here is a partnership, it is better to have a partnership agreement in place. You don't need it by law, but it is a safeguard. Make your life easier, sleep well at night without the night on. Deed of trust to transfer properties into a partnership, another part of that agreement. Do a partnership tax return, UTR, SA 400 or 401 to register. That is it. It's a one piece of paper that goes to HMRC. That's it. That's how difficult it is. And bank accounts for the partnership, one real important thing to do. If you are legitimately setting up a partnership, you don't need to change the ASTs as such, because you can just say such and such, which is your names, which you might have on your ASTs anyway. So you just have kind of, I don't know, the Smith and Smith partnership, right? It could be John Smith and Lucy Smith, for instance, but Smith and Smith partnership, and you can change ASTs if you want to, or just the new ones that you do, but do have a partnership bank account that is just used for that. Again, a tick in the box. You don't legally have to do it. HMRC, the courts haven't said you need these components in place, but to be honest, you don't need a roof on your car because you can have convertible. Have you seen it out there? I want a roof over my head because I want to stay dry. So why not make your life easier to have these things in place? I don't know where that analogy came from. I'm so sorry about the car and the roof and whatever. Oh, awful. Anyway, so that's what I suggest you do. You don't need to do these things, but we suggest you do to get things in order. And actually sitting down and going through something like a partnership agreement and being quite methodical can help you form where your business needs to go and how you structure it in the future anyway. So why not do it? So let's go back to this. So we talked about the profit is £12,000. We've got this £6,000 worth of wages that's going to Sally. Sally now takes this £6,000 worth of wages. They agree on a partnership agreement to split the profits 50-50. And now they've got a profit distribution of £3,000 to James and a profit distribution to Sally of £3,000. So straight away, what you should be seeing is the fact that the tax position on James is a lot lower, but Sally's not paying any tax because it's below her personal allowance. Now, for some of you might be saying, well, you made a mistake there because you've not pushed the salary higher and you've not utilized her personal allowance. And to be fair, you're right. I'm just using these as examples. You might want to think about your own personal situation of how to use the partnership framework to be as tax efficient rather than a limited company, which can be great, but it's not always necessary, especially if you're thinking about having a property portfolio empire for you in the long term and giving up your jobs. It's just unnecessary to use a company structure. And I'm not asking people now to throw in your limited companies because they could be very, very good. All the things I've said, you may want to stay in your jobs for a very long, long time. Limited companies are very, very useful in that situation, but you do need to think about it. Please don't go on Facebook groups and listen to the people that say, well, my accountants told me that if I don't use a limited company, Armageddon will set in. Well, no. It's really just bad advice. Don't listen to people that have got limited company. Because if you ask them the question, okay, tell me, what are the tax benefits of having a limited company? And they'll say, I don't know, my accountant told me to do it. Because I'm a lemming, I'm just going over the cliff. I don't know why. So ultimately, do get advice. Don't set up limited companies. I close them down so often. Have I got off my soapbox? Again, that soapbox. Where is my soapbox? I need it back. I need it back. So anyway, so you could be in a situation whereby James, caught you, because we could now say, well, actually, we're going to decrease the partnership split at the beginning of the partnership agreement. Don't split it any way differently. But it's just showing you that you can do all these things whereby you're saying, actually, I'll give more wages to Sally, and then the profit split will still remain 50-50, but what we're trying to do is say that the wages goes over to Sally. I wouldn't change your interest split, and I'm hoping here we are, yes. So if you're thinking about changing the interest split in that partnership, don't. This is a huge mistake. And if you don't have a partnership split, if you don't have a partnership agreement that says you have a deemed wage, but you're changing your partnership splits because you don't have this agreement in place, you don't have a tax return in place, but you're manipulating who gets what. Unfortunately, you are going to have a stamp duty land tax liability. It is under the Share of Profit Finance Act 2003, Chapter 14, Schedule 15, Paragraph 14, just in case you're bored. But I'm saving you this hassle because this would happen if you don't have a partnership agreement and you're just willy-nilly changing the profit splits from year to year. We have clients that do this, and we have got real concerns now that they're going to have an SDLT liability because SDLT in partnership law in regards to property investments means that any change of profit is a consideration. What is consideration? Well, it's money that's transferring from one partner to another, which triggers SDLT. So ultimately, if you don't have a partnership agreement and you're changing the splits because you're calling it a deemed wage, but no documentation to support it, you're in trouble. So don't do that. And again, which most accountants don't even tell you this. They just say, yes, change the split however you like. No agreement. You are going to be in court at one point or another, and you don't have anything to back yourself up. Okay, lecture in session. So in that regard, what you would do is say, well, actually, if you want to change the split, what you're better to do is give more salary to Sally, wages to Sally, and then keep the profit split 50-50 because that was in the agreement, and there are no impact now on SDLT. Perfect. That is the solution you need to put in place.
no LLP marketing tool required. You just need a nice, simple partnership which costs you £0 to set up. And then you get a partnership agreement. It may cost you £1,000 to get it set up, but actually it really can help you to understand what is required in this partnership. Who is going to do what? What if this scenario pans out? What do we do? I think that's a business contingency, which is great in this time that we're in now. So, you know, documentation is boring. I get it. It's not sexy photos of your nice room. It's not negotiating our property below market value. But none of that really matters if you're paying all your money in tax and in court with HMRC. Let's be fair. So not sexy, but really important nevertheless. So I'm just going to talk about tax now. So we're reducing the tax liability because we're shifted now all of the salary wages to Sally. The profit split is now 1,500. So basically she's got no tax liability at all. And he's got a little bit of tax, but nowhere near as much as he did before by using this partnership structure, which no one seems to talk about. I don't know why. And I'll tell you why, because no one can afford, when accountants don't make money on these type of partnerships, we can't spend £25,000 on marketing where those LLP accountants can, right? So it's up to you. Anyway, so soapbox now removed, and I'm like a little dwarf underneath the camera. So if you have liked that, give us a good thumbs up, please. Press the subscribe button and drop me a comment with any clarification questions, which I will come back to in a second. And what was the question? Right. So now you've listened to me. Do you have a husband-wife scenario or husband-husband, wife-and-wife scenario? You've got children involved. Could a partnership structure now work for you? Given what we've just said, could you manage your letting agents? Could you get a simple document from a solicitor? Could you do this £0 setup of a partnership? If it could help you reduce tax, type in yes. If no, no, and tell me why. But if it could, then great. If you say don't know, equally, don't worry, there will be this tax call to help you, which you can book anytime you want. And the description is in the URL below. So I'm going to go back now to the page just to see, because I've missed you and I've not seen you on there. Wow, there's been quite a lot of people actually. Wowzers. So let's go through. There is a lot. I'm having to scroll up here. Okay, so let's go back. Stay in there. Right. Wow, there's an awful lot. I'm going to have to go up quite a lot to chat. So do type it away while I'm still going into this. Wow, I've done so much talking that you guys have been typing away. So there is a lot here. Wowzers. Okay. Capital allowances, right? So Louis said, Babish asking, also seeing people saying LLPs is a good way of claiming capital allowances. Why can't a normal property bid partnership use capital allowances? Why can't capital allowances be used in your own personal name? Go figure. I don't know. It can. So again, great marketing technique, right? It gets you to spend £15,000 with that accountant, and you get no real benefit. Go figure. So I would stay away if I was you. I've also heard if you are single, you can create an LTD company of a partnership. Please, Babish, you've asked that question. I turned orange. It wasn't a pretty sight. I was steaming. It is rubbish. Okay, so can we stop asking that question? Please, everyone. LLP structures in an LTD framework where you're the sole owner is GAR. It is stamped all over in GAR 2016 document. Please read that 832-page document. I've read most of it. It is finished. So please don't even talk about that. So sorry, Babish. It's just, I'm not annoyed by the question. I'm just annoyed by the marketing that goes on to say you can do all this stuff when it's clear you cannot. Comedy timing, that's always good. Yeah. So let's go. Don't encourage him, please. No, Mr. Tuberview, do encourage me. I love it. It's always nice to see you there. Can you indicate some of more usual instances mentioned above, please? I might go into a little bit more detail. If you can do me a bit more of a question, that'd be better, just to clarify what you're looking for specifically. Corin saying, in Sally case, is it not better to employ and give her a salary which I can take out as an expense? Corin, that's exactly what that does, to be fair. You are giving Sally more money to reduce the overall profit, which would then split 50-50 in the example I gave, without changing the percentage split. Louis asked the question. So, Mr. Review, hi Bash, great question. The partnership needs to be two partners. A partner can be a limited company in some instances. No, not really. No, definitely not, Mr. Review, unfortunately. Hi, Karim, lovely point. I'll let Louis crack in with that, I think. Okay, I can see there's an ongoing conversation between you all, but my view is don't have a limited company with a partner that is a company. That is GAR. No. Okay, have I said that enough? I shall repeat that. Maybe not. You get the picture, right? Okay, so it's interesting to hear about LLP versus partnership and how opinions differ. Absolutely, it is an opinion, but mine's based on law. So yeah, absolutely, yeah. What can I say? So anyway, let's move on. So I'm not going to my soapbox at all, Mr. Tupu. Thank you for the question. A deed of trust, appreciate detail is not for this medium, but if a deed of trust gives you a share of income, then yes, need to do a self-assessment tax return. Yes, I'm just repeating that. So this is the point of, you don't necessarily need to use a partnership structure. You could use a deed of trust, as we talked about earlier, to transfer some of that income to your spouse, and not have to pay high amounts of tax. So you could do that for sure. Can you move properties into a limited company? Yes, you can move properties inside a limited company. You would typically have to pay stamp duty, land tax, and capital gains tax. There are ways of minimizing those two taxes, which I'll explain later on in this session, talk about partnerships and companies. So yes, you can do that, but that's easily done. Rebecca said, I am a non-tax earner. My husband is a high rate taxpayer. My first buy-to-let will be 99% to you, Rebecca, brilliant, and 1% to him to be more tax efficient. We won't be a partnership. That's absolutely fine, Rebecca. If you have a property when you're buying it, always make sure the person with the lowest amount of earnings gets the most amount of interest, percentage interest of the property. So 99% in your name. Husband, wife, who's a high rate taxpayer, then gets 1% and a reduced rate. So absolutely. Louis is just answering Jit, saying most people don't move properties to a company, a limited company. The usual commence a new company. So yeah, so back to the point of incorporation is costly if it's not done correctly. And you could use a simple partnership, not an LLP, to put those into a partnership. So you can still do that. Ryan's asked the question. Great to see you, Ryan Bettles. Nice to see you. Will do, although I need to reduce the mortgage on one property first, as it's 12K over the purchase price. I'm doing a remortgage unless I don't need to. Well, and it depends what you're doing with it, to be fair, Ryan. If you're incorporating, don't do the mortgage until you've incorporated. If you're doing a deed of trust, then please, you're a client of ours. Book a tax call. Make sure you do things in the correct way. Okay, so any other questions that's hanging over? Okay. Still reading, sorry. There's a lot. I'm so happy that people are getting their questions into me today. The partnership contract needs to be in, the partnership contract needs to be from a solicitor, or is there any template I can use? Don't use templates, Coram. There are so many templates that I see are fraught with errors, issues, and cheap is cheap. If you pay peanuts, you get. Type the answer into the comments box. That would be greatly appreciated. Does my ego award? I got that one. So in terms of Babish asked a question, what if I am married but don't want to set up a partnership with her? Can I partner with another family member? Babish, you probably need to have marital guidance. You could do a partnership with someone else. I love you, but so I would honestly look at that situation and After you've had your marital guidance, maybe speak to your solicitor to find out if you could work with a family member, but you could. That's maybe a little chuckle. I need a coffee. Let's get the caffeine going, shall we? Okay, so we have an LLP set up now. This is coming from Lucas, but never thought about paying salary to one of the partners, which is looking after the properties owned by the LLP. Great idea. Thank you. I'm a high rate taxpayer. My partner is not. Absolutely. Make sure you get that salary. Don't change an interest split because you create an SDLT liability. So make sure your partnership agreement is amended. Happy rooms. Would HMRC look into a situation where the income split has been changing over the years, but increasing steadily as the level of involvement from partner has increased? Well, if the partnership agreement is stating that year by year will dictate what that salary is, then you've covered it in one document, because ongoing you'll have an agreement at the end of the year to say you deserve this amount of money, your work has gone up. So it's worth having minutes of meetings, if anything, just to say that this is agreed, you're both signing it off. It then gets attached to your partnership agreement. Again, people will say, oh, he's overkilling it, why are you doing all this? It is safeguarding. It's paperwork you can give to HMRC and go, bang, go away. Stop asking me questions. Thank you very much. So you don't have to legally do any of this stuff. But again, do you like a quiet life or do you not? And question to you, Bavish, do you want a happy wife or just a wife? So let you answer that one as we go through. That is, Bavish, make sure you Facebook me a friend request, because that is just legendary. Thank you for making me so happy today. So happy rooms, for example, starting 5 years ago, say managing 3 properties. Yes, basically happy homes. I think I've answered it. You can do that change. That's absolutely fine. Jits asks a question: if you set up a partnership, do you need to do remortgage? No, you don't, because the partnership is in your own names. The partnership legally is you. So you don't need an LLP, where technically some of these marketing companies say, don't tell the mortgage companies. Why? Because you're breaking the terms and conditions of your buy-to-let mortgages. That's why they're saying it's not illegal. Well, it's not illegal, but you're breaking terms and conditions. That's, what's the word? Illegal. So anyway, I'm just going to go off my soapbox on that one. So to review, so LLP plus LTD or partnership co, what can single individual do? No, to review, I've already explained that, not going into it. I will ban you. If you do that again, I will ban you out of my classroom. In fact, go back to the back of the room, I cannot do these questions. So stressed, I need Prozac. Can you do a deed of trust to a property you already own, or does it have to be applied at the time of purchase? You can do a deed of trust. And Sarah, it's great to see a question from you. You don't have to do a deed of trust straight away. You can do it halfway through when you're doing your tax review. You can understand where you'll need to be in the next few years. Do a deed of trust. You do need to be careful about buy-to-let mortgages. If you change the buy-to-let mortgages as a result of this tax structure, you could well end up having to pay SDLT. So it's always better not to fall into that. Okay, I need to now catch up, because I just realized I'm kind of going on. So there's my break, not going to have a break. We're going to go straight to incorporation relief now. There's lots of people saying about limited companies. By the way, using a standard partnership, absolutely fine. Legal Partnership Act 1819, absolutely fine, can do all that. As to remember, partnership incorporation after 3 years. Now, after 2 to 3 years tax returns, my gut feel would always say have 3 years. So you might be in transition of, you've done your 2, you go into your 3rd. That's when you start to go through the process of incorporation, because it's going to take you until the 3rd tax return is done. So you need to start it on the 2nd tax return. It's going to take you about a year anyway to get through the incorporation process properly. So you want to get to that position whereby you're kind of halfway through, you've done your 2nd year, halfway through your 3rd year. Now let's get the ball rolling. But the 3rd partnership tax return needs to be submitted for you then to be incorporated. So what you would do is you would then need to identify a company. You might set up a brand new limited company, which follows suit with the partnership agreement. See how handy this is useful now? You had a partnership agreement, the solicitor uses all that information and then builds up your limited company structure. We can do that. We work with a company called SCLS, so it stands for First Corporate Legal Services. Basically, they will set up a company based on your partnership return or your agreements. And basically what you would need to do is you would need to refinance your properties and then put that into your limited company. Those marketing companies that do it, they tell you not to refinance your mortgages and not tell the banks. Remember the word illegal, breaking terms and conditions. Don't do that. Refinance your properties. Make sure that you do things ethically all times. I don't care if I get dislikes. I don't care if my name gets put out there. There is a lot of charlatans out there spouting off what you can and can't do. So do you have capital gains? Then one thing you do need to bear in mind is that here's an example. You've got an original purchase price of £100,000. The market value going into the limited company now is a market value of £250,000 with a capital gain now of £150,000. Now, typically, if you're not going to be incorporating using this partnership structure that I've just talked to you about, you would have a capital gains tax liability. Now, that will be charged at 18% or 28%, depending if you're a basic rate taxpayer or a high rate taxpayer. But it can be deferred. That capital gain, if you incorporate using the partnership structure after 3 years, can be mitigated altogether. There is no CGT. In fact, there's no SDLT either. So it can save you a lot of money by incorporating using the proper process all the way through. So what you would have to do, you would have something called a CGT deferral, which is TCGA 162. If you're really that bored and want to search it up, you can do that. You do need to calculate capital gains tax latent gains. What's that? Well, I'll talk about that in a second. Hang tight. SDLT, you also have a relief on the Finance Act 2003, Section 13, and record keepers using QuickBooks and Xero. You want to make sure that your property business has got the right information in there in your Xero QuickBooks, so we could utilize that for the incorporation process and moving all of that into the limited company and do the right numbers. Latent gains, I did say that there is a CGT deferral. That is based on what the market values have been on original purchase versus what it is now when you're incorporating into the limited company. Latent gains is different. There is a CGT even on latent gains. So let's go back to that property, £100,000, but the property valued up at £200,000 and you've got a remortgage of £120,000. Well, there's an issue now because you have got this thing called a latent gain. A latent gain basically means it's the excess of your mortgage versus the original purchase price. Now, this is deemed to be a capital account in the legislation of HMRC. So I like doing that. So let's do that again. Capital account. Maybe do it with me. Capital account. No, that's really embarrassing. Let's just carry on. You could have original purchase price, £100,000, remortgage of £120,000. That excess of £20,000 now would be subject to CGT at 18% or 21%. You cannot defer that. That has to be paid. So there are consequences of even incorporating, especially if you've been doing this buy or the buy, refurbish, refinance way of doing things. That could put you in hot water if you later wanted to incorporate into a limited company because you will have this latent gain. That can be a problem and that could be a showstopper for a lot of people. So it does depend on going through this process and getting things done correctly. So hopefully that's been useful. I'm just wary of time now because I'm just looking at my time. It's now 7 minutes and I've still got to do, I won't have time to do CGT after all. I thought I was going to be able to do it, but that was my bonus thing if I had time. I want to talk about limited companies. So what I'm going to do is ignore this. I do want you to smash that like button and also press the subscribe button as well, if you don't mind, and drop any comments in the comments box with any questions that you might have. And we'll go on to limited companies. Whilst we're doing this, just so I can whittle through these last slides here, are you thinking or are you using a limited company from your property? Bearing in mind what I said about using a deed of trust to move income between spouses, using a partnership structure and not necessarily having to do an incorporation. Or indeed, are you thinking, those are good ideas, but I still need to use a limited company? So type in yes if you are either using a limited company or thinking of using a limited company, or type in no because you don't need to. So do that right now, and let's have a look at some of the questions that's been going on in terms of the, Louis just saying, please ignore him, Mr. Tuberview. I'm on my soapbox, I will do what I like. But Mr. Tuberview has now gone quiet. I apologize, please come back. You can come back to the front of the desk, and I will give you my toy dinosaur as well, but don't break it because it's mine. So let's just have a look at the some of the questions that we've got going on here. Paul, not sure what that is. Is that cryptic? Please help me out there. That's making me spooked now. So questions. Can you backdate a partnership agreement? Ideally not, but I guess if you could say that you've legitimately been a partnership in the past, then could you backdate it? I guess you could, really. It's something for you to work with a solicitor on, I guess. Tuberview, oh, he's back. Oh, that's all right. Would this workshop be on the channel to watch later? Tuberview, it is going to be live now, and it will stay there forever and a day until I get bored of it. So, questions coming in. So let's just have a look. So I'm not sure what happened there. Just shot with lots more questions. Thanks for the content today. It's great. You are very happy. I was about to say you're very happy rooms. You're very welcome, happy rooms. I'm pleased it's useful. Starting as sole trader, but maybe a limited company in the future. Rebecca, based on what you've said, don't think you need it. Save yourself some money. Mr. Review, seems like some really important points can fly. I need to listen again. Oh, absolutely. Yeah, I agree with you. If you have time, would it be possible to hear more about the process of incorporation, timings, mortgages, switches? Happy rooms, unfortunately, it's a huge, huge deal. So it is worth booking a tax court. It's not the easiest of processes. I think our checklist is 68 boxes to go through. So it's not something that I can do that. Can you claim food expenses? Yes, you can, Parol, but as long as you are moving about, so you're working away from home, then you can claim food expenses. I do have a video on that, so make sure you go onto our YouTube channel. Do go onto that. Are you using a limited company? No one's. Lots of people have said yes. So let's get into the content. So let's think about this. So before we use limited company, the one thing I want to show you is if you had a net profit of £100,000, you'll see the tax bandings there, but in a sense, you will have a tax liability of £27,500 if you have net profit of £100,000. I'm ignoring section 24 because that would be a killer to do the workings on, but it would be more potentially. So I'm just going to say it's 27,500 based on someone with unencumbered properties, or the 100,000 is taking into account the mortgage interest relief cap issue anyway. Now, the thing about limited companies, I'm going to do a comparison now of that 27,500 tax that's in your own personal name versus what will be deemed in the company if you was to go that way. But what I want to go through with you is what money can you take out of your limited company from April 2020. So this is really up-to-date information that you could use. So you can take out of your company £8,788 tax-free as you as an individual. You could take that tax-free and national insurance free as well. Now, I know there's been some changes in regards to national insurances and saying, well, it's higher for employees, but you as a limited company owner would have to still pay some element of national insurance above 8,788. So my view, stick to 8,788 as wages per annum. So this is salary per annum from your limited company. It will be tax-free. If you have a director's loan account going to the limited company, you can charge your limited company between 6 and 8%, which is HMRC guidance, interest on the money you've loaned. So that technically means that you could take out £5,000 saving allowances by charging your company this interest, or you could have £1,000 interest as well, in addition to the 5,000 if you're a basic rate taxpayer, or £500 as a high rate taxpayer. So there's lots of things you could do with that as well. You could take £2,000 worth of tax-free dividends out of your limited company. And finally, which is very useful, don't hear many accountants talk about this, but why? Is you can take out £300 non-cashable vouchers in a given year. Now, what I would suggest you do is that you get your company to give you a voucher, £50 every month or so. So maybe every 6 weeks. So it's no more than £300 in a year. So your company, your legitimate expense could be where your company buys you John Lewis vouchers and gives you a £50 voucher every 6 weeks or so. And that you can spend that, and there's no tax liability, but it is an expense of the company. So there's a tax write-off from the company, no tax to you. Why is no one talking about this? I don't know. But anyway, it is something that you can certainly do. So, and this is my point. So you could pay yourself £9,000 for employees, but then you get this employer's national insurance charge. So I wouldn't do it. My view is pay yourself a salary of £8,788 from your limited company to you as an individual. Now, it does depend. If you have other taxable earnings, this probably doesn't apply, but I'm telling you the things you could do if you have now all of your properties inside of a limited company. So it just gives you a bit of a comparison. So tax-free wages. So remember here, you've got tax-free wages of 8,788. You can take £3,712 worth of dividends to get to your personal allowance. Now, you should know your personal allowance is 12,500. That remains in 2020. You don't have any tax liability at all. So that dividends is below the personal allowance, but it still means you can get an additional £2,000 worth of dividends as well. So remember, the personal allowance is now 12,500. So you're taking that in the form of wages and dividends. You've still got this £2,000 worth of extra dividends you could take out. You can now take savings and interest charges out against your company at 6,000, which again would be a tax deductible for the limited company. So you're decreasing the amount of corporation tax, and you've got these vouchers at £300. So I've now shown you a way about the hey sister. I've shown you, sister, of how you can take £20,800 out of your limited company tax-free. Awesome, right? I mean, that is awesome. You could take £20,800 and that would be tax-free in your pocket. Let's work this out. If you're a husband and wife, you can now take out what, over 40 odd £1,000 out of a limited company, 41,600, just doing the maths, 41,600 out of your limited company tax-free in your household. If you've got an adult child, you could do another wow. That is an amazing amount of money that you can generate out of your limited company and no one pays tax. Go figure. So from the company perspective, you've got this £100,000 worth of profit. You've got wages, 8,788, less the interest, less the vouchers, gives it now a profit, a reduced profit. You can see all these costs now coming out of the company. You will note that the dividends is not here. And that's because dividends is not a tax deductible. It's after tax is paid, then you can distribute the profits. So it's not a tax reducer in this regard. Only the wages, only the interest, only the vouchers. That gives a restated profit before tax of 84,912 in the limited company. That will remain at 19% tax. By the way, I have to say, throughout this week, I was quite frustrated because before the votes took place to elect the Conservatives into power, one of the things that Boris Johnson said was, well, I will reduce the corporation tax to 17% if you vote me in. And then he stuck it at 19%. I'm not really, as a Conservative voter, I was quite frustrated with that. But now I have to look at what him and Rishi Sunak have been doing this week. And I got to go, I will pay you 3% more, you know, because these guys are legends. They are such, I give them such respect for putting this economy back on where it needs to be with this coronavirus. And they look tired, man. They look, I mean, I feel tired. I've been building these slides and following them and putting, but they're doing all the work to help us in this country. And I'm totally appreciative, and thank you to Boris and so thank you to Rishi to doing that. So the fact that they haven't reduced corporation tax, man, I don't care. Take that 2%, utilize it for the greater good, because that's what it's there for. But anyway, that said, the net profit now can be taken as dividends. Now, here's the kicker, because what you will do is, I'm going to ignore that. Here we are. What I want to show you is you're going to take all of this money out of a limited company. So you've got tax-free wages of 5712, which is now the excess of personal allowance, etc. Now, the problem is with this is if you're taking money out of your limited company, you are going to have to pay dividends tax. So if you're saying, well, okay, I'm going to take the excess of £20,000 worth of dividends, I'm going to have the rest taken out of my limited company. Therefore, I've got this 7.5% tax liability. I've also got the 32.5 tax liability, and the excess become a higher rate taxpayer. Me as an individual, if I want to take all this money out of a limited company and not leave any money inside that limited company in excess of the original £20,000, I've now got to pay an income tax liability of £13,197. So we've gone now from this thing of having own income or own name, we've got a income tax liability of £27,500, as we said before, by having the properties just in your own name. But if you want to use a company and have all your profits in that, but you want to take out all of the remaining money that's in that bank account for your own personal lifestyle, well, I've got to say to you straight away, you'll be leaving with less cash than if you kept everything in your own name. Let me restate this. If you had £100,000 of property profits in your own name, the maximum amount of tax you would pay is £27,500. I appreciate I might have gone quick, because I'm wary of time. You can rewind. But if you had your property company earning £100,000 and you sucked out all the money, so you got tax-free income of £20,800 plus the excess of up to £68,000, so you suffer income tax on those dividends. The company's paid £16,000 worth of tax. So now net position, you're worse off. And don't forget that I've already said that the disbenefits of a limited company is the fact that you have to pay an accountant to do it. Your buy-to-let interest rates are going to be slightly higher, even if they are getting more competitive. And you've got this ordeal of dealing with confirmation statements, ATED reports, blah, blah, blah. So this position would say it's a waste of time. Okay, using a limited company, if you stopped this video, you'd be feeling dejected. So don't worry, there is a positive to this. But if you're using your limited company to extract every single penny for your lifestyle purposes, don't bother. You may as well keep it in your own name, have unencumbered properties, and live off it, and just have the 40% tax band as a highest rate of tax that you'll pay, unless you're an additional rate, which would be 45% if you're over £150,000. But ultimately, using company structure only works if you keep money inside the company. There are things you can do with it. The company, with the money that you leave in, let's imagine that you didn't take out that, you're happy to take $20,800 out of the company. You and your spouse, your partner, happy to live off that money. The remaining $68,000 that was inside that limited company, you might want to invest it inside in new properties to grow the wealth inside that company. You might want to invest in shares. Now, Louise and I invested money straight into the shares when the stock market, we saw the stock market go below 5,000 points. Wow, what a bonus. Let's get in there now and make some money, right? We may take advantage of the situation. Stock markets will go up at some point. They may go down to 4,000, okay? I don't care, but they won't go bust. They will go back up to maybe the 6,000, where I kind of think that the FTSE 100 should be. I'm not a financial advisor, but 7,000 was a crazy valuation for FTSE 100, in my opinion. But 6,000, it's way short now of that. So I've invested money in shares. That's something you could do. The company could invest in pensions. So let's not forget, at some point in time, we're going to retire. You could use your company to put money into your personal pension, and it would be a tax reducer for the company, and it then goes into your pension for you tax-free, which is good. You could use your money inside the limited company to save for medical treatment. So if you need a medical annual checkup, if you're over 40, do it. Go to a private GP, get a private certificate done, and then you will have that paid by the company. Or keep in business bank. That's just a bank. Keep in business ban. I don't know. Is it a business ban? Should we be banned from using limited companies? That's not what it's saying. It is a safe. So maybe that's giving you a connotation. I think it's just fallen off. It's given up. It's listened to me too long. It's just, and then the K's gone. K's gone. I knew him well. I knew him well. So keeping the money in the business ban. So that's the things that you could do. So has this been useful? Give it a like, give it a subscribe, give it a comment. And are you now thinking of using a limited company? I don't think that's going to change too much, really. So what I'm going to do is do this kind of fast forward pace in a second and ignore it. So I'm going to go see if there's any questions that there have been set. So Mr. Tuberview now back in the front desk looking after my pet dinosaur. Hopefully you've treated him well throughout this session. So Tuberview just said, seems like really important points. Oh, you've already said that, sorry. Ignore that. I need to think carefully as it sounds you are. Structure you need to meet your needs. Bavish said agreed. Okay, Stephen Crouch, not Peter Crouch. I was getting excited. Stephen, I'm still very excited you're here. Still very excited. At least I could talk at your level. That's amazing. So our payments into a pension scheme, taking 8788 wages, 2,000 dividends. Can the company pay all the other potential profits into a pension scheme? Yes, up to £40,000 per annum per director. So yes, it absolutely can do. Louise has already answered that. Oh, darn it. Rebecca Cook, yay. We've changed Rebecca's opinion. She said yay to a limited company. Now she's saying no, and she doesn't need it, quite honestly. So this is being very, very useful, I hope. It is now 11:10. I'm way over my thing, so I'm going to go and ignore this capital gains tax. Oops, I've just shot past my slides, so just bear with me a second while I get my slideshow left, because there is something I want to announce to you all. And that's really disastrous because I've now gone past my 100 slides and I've got to do them all again. So do bear with me a sec. Ask any question you have in the remaining couple of minutes we are together. I'm just going to go to the limited company thing. Wowzers. In fact, what I'm going to do is just come out of this and just go to that. Okay, so current slide. Perfect. Just going to do a share now and go back to the PowerPoint that I mistakenly went through. Okay, so it's a thank you. It's just to say thank you very much. I love doing these things. I used to do the workshops live, but this saves me time and money and, quite frankly, hassle. And for you, it saves you time and money. So why not do it live going forwards on YouTube? So I'm going to do it next month about tax structures. But if you stayed around, here's a gift. For you that stayed on, if you found this interesting, obviously I've told you to do the press, the like, the subscribe, but here's some bonus content for you. Would you like to have an hour with me for free? If you have answered yes, all I would like you to do is on your Facebook and LinkedIn accounts, I would like you to share the URL of this video when it's processed, so give it a few hours, copy, paste the URL from this video, put it on your LinkedIn profile, your LinkedIn Facebook profile, so it's like disaster. Facebook and LinkedIn profile, tag me in as well, and just give me maybe 3 bullet points of why you felt this course was useful. Just 3 points. So share the link on your Facebook and LinkedIn accounts, tag me in, and 3 points that you thought that this course was useful. And I will take a pick out of there and I'll choose maybe 1 or even 2 people, depending on how the likes are. And I will pick you and I will give you 1 hour of my time. So I do need to reach out to you. So that's why I want you to tag me in. And I'll reach out to you. I'll randomly pick them. And I will then give you an hour free of my time. So do that as a way of saying thank you. Like I say, next month, I'm going to do this again. In fact, what subject? Before we go, I see people disappearing. If you want an hour of my time, so remember, Facebook, LinkedIn, URL of this video, tag me in 3 points of why it's good, okay? And then I'll pick you an hour at my time free. But the other side to it is, what subject would you like me to do next month? Because I'm quite keen to do maybe an hour session or an hour and a half session. 90 minutes sounds about right. Maybe 2 hours a bit overkill. But what tax strategy, what property investment strategy would you like? I know you can go to courses about property investing. I've done property investing for many, many years, and I've never really shared that information. So would me sharing my information with you about property investing be useful to you? Happy to do that. Or would you like me to stick with tax? And if it's just tax, what tax issues should you, what should I be addressing for you? So type those in as we go through, and that would be really, really useful. So let's just have a look now at some of the questions before we go away. There are some questions and I want to answer them. So let's just have a look. Okay, so Sarah, let me take a watching again. Thank you. Corinne said, thanks, Simon. Thank you very much, Simon and Louise, for the session. Extremely useful. You're very welcome. Lucas has said, thank you, Simon. Happy to go through the slides again. Perfect, good. Sue Robertson, thank you. Rebecca, thank you. You're welcome. Teo, where can I find the replay of this? This is the same link. So if you go to our YouTube channel, this video will be on there and you can watch that, no problem at all. Mr. Two of you, I think next level for me, thinking, oh, sorry. I think the next level of thinking for the older investors is IHT. Where's the pros and cons for the various structures? Good question. So why not for me talk about tax structures and wealth planning? I think that'll be a good, useful video, maybe. So that'll be, you know what? That's it. Bam. That's my next subject. So tax structure and wealth planning for the family generations. How about that for a snippet? If anyone can give me a better title than that, because it's a bit long, I would really appreciate you doing that. Inheritance tax strategies. Okay, someone else has said the same thing. Pros and cons for structures. Yep, perfect. Okay, rent-to-rent deal sourcing, please. Coram, to be fair, rent-to-rent deal sourcing, there are so many better people than me on that. I'm not very good at it. I've never done rent-to-rent. I'm not sure I could do a course on it about that subject, so I wouldn't be very good. I've got to be honest. Thank you. You're welcome. I'm glad you enjoyed it. SAS and IHT. Manish, I'll probably do IHT. SAS, a bit more trickier. I don't have a SAS, so I don't know about them. I know there are tax advantages of SAS, but I don't really use them. Usually I learn most in real cases when I talk with fellow investors and we go deep into go deep into a conversation, happy rooms, or go deep into a conversation. So yeah, so in terms of wealth creation, sounds good. Legacy planning, great. I even get what I want. I will be here at the perfect service. W, you're perfect. I'm having my dinosaur back now. Thank you very much for that, looking after him. And I will leave you now and say, have a great week. Don't forget, I will be doing the coronavirus updates on this channel every weekday. So Monday, Tuesday, Wednesday, Thursday, and even Friday, because there's no pubs open anymore. So that Friday even, I will be doing an update between 8 and maybe 8:30, talk about coronavirus and all the updates. There are so many updates that have come over on Friday that I'm going to be talking about on Monday. So please stay tuned for that, and I'll see you again soon. So my name is Simon Misiewicz. You've been a wonderful audience, and I've got as much out of this as I possibly thought I would have done. So thank you, and have a fantastic, awesome weekend.